Today, we're going to try and take this huge abstract concept, the AI supercycle, and really ground it.
Ground it in cold, hard numbers.
Exactly. In cash and operational reality, we're deep diving into the sources around two companies that I think really define this whole boom. The hardware layer with Micron technology, and then the software on top, Palantir.
Right. And for you, the listener, we've synthesized a pretty heavy stack of material today. We've got financial analysis, we've got the latest earnings reports, analyst commentary.
All of it.
All of it. Our mission here is really to give you a shortcut, to get you past the soaring stock prices and into the financial architecture underneath. And that means understanding the massive opportunities, yes, but, and this is critical, also the very high stakes execution risks that are tied to this whole investment cycle.
So let's start with the foundation then, the silicon. Micron Technology, ticker MU, I mean, the run-up has been just dizzying.
Oh, absolutely.
The stock had already soared, 195.3% in the year leading into these results. You'd think with that kind of move, all the good news is already baked in.
You would think. But the numbers, well, the recent numbers tell a very different story. The reason for all this optimism heading into 2026 is rooted in a just blockbuster set of results for their fiscal Q1.
Okay, so let's get into those. What was the headline number?
The headline revenue figure was $13.64 billion.
Wow.
Which is a jump of nearly 57% year over year. But, I mean, the real story, the leverage, showed up on the bottom line. Their non-GAAP earnings per share jumped an explosive 167% year over year to $4.78.
That's incredible scale. But the question is always, where is that money coming from specifically? Which business units are actually fueling this?
And the company was crystal clear on that. The most dramatic driver they pointed to was their cloud memory business unit, the CMBU. And if you're prepping for a meeting, you need to know this one. It's their division that sells high-margin, specialized memory straight into the big data centers.
The cloud providers, the ones building out all the AI infrastructure.
Exactly.
And what did that CMBU growth look like?
It's just shy of a double. Sales hit $5.28 billion. That's an impressive 99.5% increase year over year. It's almost pure, unadulterated AI momentum hitting their best segment.
Right.
But what's really fascinating, though, is that even those incredible Q1 results, they were almost immediately overshadowed.
Overshadowed. That's saying something when you're talking about triple-digit EPS growth. How?
But by the guidance they gave for Q2, this wasn't just beating expectations. This was Micron basically signaling that this whole memory supercycle is shifting into, well, hyperdrive. It defied even the most bullish models.
I remember seeing those guidance numbers and they were just staggering. Walk us through the forecast that really shocked the market.
Okay, so the Q2 revenue forecast,
What?
they guided to $18.7 billion.
18.7.
And to put that into context, the consensus on Wall Street before that was only $13.74 billion. That gap, that almost $5 billion gap, funnels straight to the bottom line. They guided for a non-GAAP EPS of around $8.42.
And what was the consensus expecting?
This is the amazing part. The consensus was predicting a loss of $4.47.
Wait, from a loss to a massive profit
Yeah.
in one quarter? That just screens pricing power. But the number that really defines this whole thing is the margin.
It is. The one number that confirmed they are in complete control of the market right now is the gross margin forecast.
68%.
68%. Okay, let's unpack that for you. For decades, memory has been seen as a commodity. It's famous for these brutal swings where margins are maybe in the low 30s or even go negative.
Right, in a trough.
So what does a 68% margin confirm about the business today?
It confirms that Micron is, at least for now, escaping the physics of that commodity cycle. A 68% margin is, it's historic for a memory company. It means they're selling something so specialized, so differentiated that there's no substitute. They're basically the toll collector on the AI highway.
So why? Why is that pricing power so extreme? Why are customers paying whatever they ask?
It boils down to a structural supply constraint around one critical product, high bandwidth memory or HBM.
These aren't your normal RAM sticks. Not at all. These are highly specialized stacked memory cubes that sit right next to the big AI accelerators, the GPUs from NVIDIA and AMD. They're essential for that lightning-fast data throughput. The accelerators literally can't run at full speed without HBM.
So AI needs more and better memory to perform better. It's that simple. What did management say about availability? Because if it's driving 68% margins, it'd have to be incredibly scarce.
Scarcity is an understatement. Management confirmed on their call that their HBM is completely sold out for the entire calendar year 2026.
The entire year.
The entire year. And here's the key nugget for you. The volume and the pricing for that supply are already locked in. So think about what that means. If you didn't secure your HBM supply from Micron back in 2025, you are simply locked out of building new large-scale AI clusters for the next year and a half.
That completely changes the competitive dynamic. It's not about price anymore, it's just about access.
Exactly. And they kept emphasizing that this demand is structural. It's driven by multi-year data center builds, not just inventory stocking. You can see it in the numbers. DRAM revenue, which includes HBM, was 79% of total revenue in Q1. It did $10.8 billion,
Which is a huge jump.
69% year over year. The AI segment is just overwhelming everything else.
So it's not just the high-end stuff then?
Well, the rising tide is lifting all boats. Even NAND flash memory, for storage, is seeing strong growth. Q1 NAND revenues were up 22% year over year. That's partly their new SSDs, but also because data center customers are just trying to find anything they can to compensate for a chronic lack of hard disk drives.
So the story so far is just pure, explosive, demand-side euphoria. But this is where it gets really interesting. This is where the risk lives. The challenge isn't getting orders, it's execution. What is Micron actually doing to meet this wall of demand?
This is the highest stakes part of the whole story, and it's where they could fall into that historic memory industry trap. To meet demand, Micron raised its fiscal 2026 capital expenditures to a staggering $20 billion.
$20 billion. Up from 18.
Up from 18.
But wait, isn't that the classic mistake memory companies have always made? You flood the market with supply right at the peak of a cycle, and that huge CapEx investment just becomes a massive liability.
That is the essential risk. But they believe this cycle is structurally different. They're making a massive, you could almost say reckless, bet on future demand. I mean, $20 billion is roughly the annual infrastructure budget of a small U.S. state.
They're betting the company.
They're betting the company on their ability to build and bring online what they called some of the largest and most complex factories on the planet. Construction CapEx alone is expected to roughly double from fiscal 2025.
That kind of scaling just introduces so much friction, technically and financially. So where's the biggest risk day to day on the factory floor?
It lives squarely in the yield curve, the ratio of good chips to bad ones. Their success hinges entirely on these rapid technology transitions. For instance, they need successful, fast yield ramps for their next-gen HBM4 product. And management is publicly saying they expect HBM4 yields to ramp faster than their prior products.
That sounds aggressive.
It's extremely aggressive in the world of semiconductor manufacturing. And it's not just about HBM. It's about their core capacity for everything.
Of course.
For their overall bit growth targets in 2026, they are relying heavily on moving to cutting-edge manufacturing processes. The 1-gamma node for DRAM and the Gen 9 node for NAND. When we talk about these nodes, we're talking about the deep engineering blueprint.
A recipe for making the chip.
Exactly. And those new recipes are inherently risky because they're brand new. This is where the steepest, most complex part of the yield curve always is. Any slip up there, and billions in demand go unmet, and that beautiful 68% margin just vanishes.
And there's an operational rigidity to consider here, too.
A huge one. The CFO noted that just changing wafer allocation, say, shifting production from HBM to conventional DRAM, takes roughly 5+ months.
5 months. That is an eternity in this market. And that constraint leads directly into the big strategic dilemma. If you're sold out and demand is overwhelming, you have to decide who gets the chips. So what is the long-term cost of chasing today's AI profits?
It's an incredible challenge, the allocation problem. Management acknowledges they have a significant amount of unmet demand, and they're trying to find a threshold level of supply for everyone. But they are deliberately tilting the business toward the higher ROI data center segment.
Which makes sense financially. You go where the margins are, but what does that trade-off actually cost them in the long run?
It costs them stability. By aggressively prioritizing the data center, you risk alienating customers in these really stable, long life cycle segments.
Like automotive or industrial?
Exactly. Automotive, industrial controls, even mid-tier PC builders. These partners need reliable, decades-long supply. They are lower margin, yes, but they provide this essential, stable baseline volume for when the AI supercycle eventually slows down.
So you're trading today's lottery win for tomorrow's steady paycheck. How are they trying to manage that, to mitigate it?
Well, they're making some specific investments to protect those relationships. For example, they're modernizing their fab in Manassas, Virginia, specifically to bring older 1-alpha technology online for these long life cycle legacy products. It's their way of saying, we see you, we haven't forgotten you.
But the risk is still severe. I think management even admitted that if customers in, say, the PC market face supply limits because all the wafers are going to HBM, they might be, and I think this was the quote, encouraged to figure out other sources of supply.
That is the core tension of this entire supercycle. If those stable partners switch now because they can't get parts, it creates a permanent opening for Micron's competitors. They're sacrificing stability for profit acceleration. It's a huge gamble.
Okay, so we've established the incredible physical constraints on the hardware side, the silicon, the yields, the $20 billion in CapEx. But what happens once those racks of HBM are actually running? You have this explosive demand for intelligent software to process all that data.
And that brings us to Palantir Technologies, PLTR, the software counterpart.
Right.
Palantir's spectacular growth, their stock was up 145.5% in 2025. It really reflects the sheer scale of data being generated by the hardware that Micron is supplying. It's the yin and the yang of the AI boom.
So what do the numbers look like on the data analytics side for them?
Their Q3 revenue was $1.18 billion, up 63% year over year. The key driver here is the really rapid adoption of their flagship product, the Artificial Intelligence Platform, or AIP.
And this isn't just basic analytics.
No, AIP is designed specifically to accelerate decision-making by taking these vast, messy data sets and applying AI models to them immediately. And that adoption is hitting both their classic government clients and their newer commercial side.
Right, which has been a huge growth area for them.
A huge growth area. Their U.S. commercial segment revenue soared 121% year over year to $397 million. That triple-digit growth shows you how Fortune 500 companies are scrambling to catch up. At the same time, their traditional government revenue was up 52%.
So the synergy is pretty clear. Micron builds the high-speed pipes, Palantir provides the intelligent framework to make the data useful. But why does that create a competitive barrier?
It creates what the analysts call meaningful barriers to entry. Because AIP isn't just a simple software package, it integrates so deeply into a client's existing, often ancient infrastructure. Once it's embedded, ripping it out to switch to another platform is enormously expensive and time-consuming.
It becomes sticky.
Very sticky. They're projected to deliver earnings growth of 42.5% in 2026, which suggests that this integration mode is proving really effective.
So when we put all the pieces together, what does this all mean? We have Micron confirming this structural shift with historic 68% margins, these unprecedented $20 billion CapEx plans, and then Palantir showing the software value with explosive adoption.
It means the market is already pricing in a permanent paradigm shift, not just another cyclical peak. Let's just look at valuation for a second. Micron is trading at 4.72 times forward sales.
And what's the historical average?
Its 5-year median was 3.02 times, so that's a significant premium.
So the market is betting that the memory business has fundamentally changed, that the commodity era is over, and this is now a specialized, high-margin AI infrastructure business.
Precisely. That huge premium has to be defended by the market believing that a 68% gross margin is the new normal. However, there's one crucial caveat we have to mention, and it came from management themselves.
What's the catch?
Management noted that margin expansion from that Q2 guide of 68% will be more gradual going forward. That specific wording suggests that the steepest, maybe the easiest part of the profit climb is ending. And from here on out, defending that valuation rests entirely on successful volume execution and managing that massive $20 billion CapEx plan without stumbling on those yield ramps.
Which brings us to our final provocative thought for you, the listener. Given that Micron's ability to meet this demand is restricted by that 5-month production lead time, that deep operational rigidity, and they are, for all intents and purposes, telling their non-data center customers to find other suppliers today, how will those short-term operational decisions impact the stability of their business when the AI supercycle eventually transitions to a more normal, less constrained cycle, say 2 or 3 years down the line? It's a delicate balancing act, maximizing today's profit while securing tomorrow's partners. Thanks for diving deep with us.